What is going on, everybody? Today we're going over DraftKings. DKNG is the ticker symbol. We're gonna go over the financial statement of DraftKings, the betting app. Everyone are loving DraftKings. Everyone are talking about it. We're gonna do two things. We're gonna go over financials. That's number one. Number two, we're gonna go over a tool for Think or Swim to see the relative value and of DraftKings. Is it a good buy now or isn't? And be honest with you guys, this tool I've started to use in the last couple of weeks, and so far I can't believe I have traded all those years without using this new tool that I found out. I'm gonna do all of that, and I'm gonna give you my opinion about DraftKings, and you will see for yourself using the tool. Is it expensive or is it cheap relative to the competitors? So with that being said, let's get started with DraftKings. Yeah, I'm in Yahoo Finance. DraftKings, ticker symbol DKNG, price today $61, up another 3%, all-time high. It was 64. Okay, this was a SPAC that started, I think, $20. Let's click the let's say 1 year. Started in February. Okay, yeah, let's do it. Here we go. Started pretty far away. The SPAC started August 19 when nobody actually knew what SPAC is. $10, ran to 40, ran to 60, and then to 60 again. We got earnings coming up in about a week and a half. 52-week range was between 10 and 60, so it's all-time high. $24 billion market cap, that's what we got. And the 1 year target for 2021 for DraftKings is $62, which is where we are now. However, everyone are loving DraftKings, and I will show you after the financial statement why it is not a good idea. But stick around to find out. Let's go over some numbers. As for the analyst, let's see what we got. The average estimate for 2021 is for every share that you hold, you will lose about $1.28. That's a negative 128. It's still growing. There's nothing wrong with that. I just can't do a Buffett fair value valuation on the Excel because it's a negative earning per share. And if you scroll down, you got the growth estimate, supposed to grow by 40% every year for the next 5 years. That's pretty awesome. Next year they're gonna grow by 36%, but next quarter, which is basically where we are now, Q1, we got a negative 12%, which is interesting. So they're not expecting to grow this quarter. Before I go over the financials, I just want to mention that in my opinion, all the big players, MGM, Wynn, Caesar, Las Vegas Sands, all those big players will most likely do online betting as well, not just DraftKings. And they're not the only one. There's also Penn. We will go over Penn company as well. They're like the biggest competitor as of yet. Here we go, PENN, Penn National Gaming. But I assume the big players will come into this market and basically take shares of DraftKings moving forward. I don't know if it's gonna happen today, but most likely it will happen, and there will be a lot more competition. Yes, they're gonna make legalized online betting, everything all over the state. I agree with that, but DraftKings will not be the only player, and you better bet that the big players will be in this environment as well and take the majority of the shares from DraftKings, in my opinion only. Let's move on to the financials, but this is something to consider if you are a DraftKings holder. That's basically it. Let's go over financial statements. Let's see what we got. Income statement for the finance. We got ourselves total revenue. I want to see that it's growing. First of all, going from 226 million to 323. That's extra 100 million or 30%. That's good. And then another 100 million to 423, another 30%. So every year they grew by 30% revenue. That's not bad. Let's see how much gross they make from that. 177 million, 220, 200. So it's a little down. It's about the same. But let's say 196 compared to 420. So they're like grossing about 40%, which is not bad. Not bad at all. Buffett is looking for 40% growth. However, if you scroll down to here, the net income per share is negative 600 million, compared to negative 150 million, let's say 143, compared to negative 76. So the more they expand, the more money they're losing every year. That's no, it's part of the business. At this rate, they're not going to be profitable anywhere near near-term future. They're not going to be profitable, and that assumes that everything stays the same and no one comes into this marketplace. And by no one I mean the big guys, Vegas, all the Vegas players, basically. That's what I think. And if you went from 76 million negative, double that negative to 150 a year later, and then quadruple that 4 times negative to the worst side, from 150 million to 600 million, it's not a good sign. I know you're expanding. I know you want to do online betting, but you know, I see the numbers. That's what I see, and it's not good. Let's move on. In the balance sheet, I do not have the 2020. All I can see is 2018, 2019. To the left, it stays the same. 300 million, 330 million. Sure, they grew by 10%, but not a big deal. Let's see the liabilities, the non-liabilities. So they have about $68 million long-term debt. In 2019, I can't do anything about 2020, but zero long-term debt in 2018. So they keep taking on more and more leverage and more debt and more expanding and more negative, and yet the stock is at all-time high. Just shows you the way of the market. But it's not gonna last forever. Let's move on. Go over the cash flow. Let's see what we got in here. The last 12 months, issue of capital stock, diluting the shareholders, issue more stock, 1.3 billion compared to 8 million like a year ago. That's insane. Just insane. In 2019, they did nothing, and in the last year, they just diluted insane amount of shares for the shareholder. And while you hold a $60 share today, doesn't really worth $60. Again, my opinion only, not a financial advice. That's a bad number. Issue of capital stock, that's a very bad number, 1.3 billion. Issue of debt, again, 70 million took on loans a year ago, and now it's 112 million. They did pay 7, so they paid 10% from the 70 million that they took, and they still took another $100+ million. Did they do any buyback in the last 12 months? No, compared to what, 7 million like a year ago. Free cash flow, they ended with $300 million negative compared to 120 million negative compared to 70 million negative. So almost 3 times to the worse on the cash flow side. And sure, everyone in the comment will say, no, you're wrong, they're a growing company. Yes, they are growing, they need to expand, they need the money. I understand all of that, but let me show you something else that might open your eyes to a new way of trading. And no, I'm not an affiliate or anything like that. I just found out about this about a month ago, and I can't believe that I haven't used it ever before. Let's get started. I'm gonna show you Think or Swim next. And also real quick, before we go over the tool, go here quickly to DKNG DraftKings SEC Form 4. The website is Insider Trading, right? Open Insider. Here we go. That's the website, openinsider.com. Check if they're buying or selling, and look at this, all in the red. All in the red in this date, October 9th. Okay, October 9th, we got a couple of, everything is sell basically. Director, different people. Morris, Steven, Mackenzie, Shalom, Salter, Joe, Nada, Hani, Muri, Ryan. All sold for a price of $50, 50.83, 50.83, 50 bucks. We're now at 60. You think it's gonna go to 1,000? Okay, you think that. There's nothing wrong with that. In June we got a couple of sales at 38. I don't care about sales and option exercise. That's doable. And again, more in June, which I assume the time to sell was like 6 months after. I don't know. I haven't followed them, but a lot of people sold at 38. And if you just bought a bag at $60 because someone on Reddit or Twitter told you that it's going to the moon, read the financials first. That's all I can say. And look at this amount: 350 million, 250 million, 50 million, 50 million, 30 million, 70 million. 130 million, 40 million, 180 million. There's a reason why all those shares get diluted, because so many people, directors and insiders, are selling. Who are they selling those shares to? Probably you at $51. You probably bought it at 51 and now it's 61. You're happy, but it's not, doesn't mean that it's gonna last. With that being said, let's go over the tool that I wanted to show you guys. So this is Thinkorswim. Okay, this is the ticker symbol DKNG, DraftKings. I want to show you something, guys. This is what I got. This is DraftKings. Okay, this is what they've done. In the red and green, that's DraftKings. What do you think is the purple? I'm gonna show you. You click study right here, okay, and go to edit studies. And I just did it before this video. And I just you put in the search bar, you put comparison, okay, COMP, comparison. You add that, and then you click here, and you just put the most compatible. Most like, let's say Tesla versus NIO, or Nvidia versus AMD. So when you look at the stock, let's say DKNG, sure, the price is 60, but what does it mean? Does the price is high? Does the price low? Does the price is fairly valued? Because I don't have the value from Buffett, because everything is negative, I don't know if they're overly valued or undervalued. So what I do, I just put the competitor, the most direct competitor. So I put secondary security right here, PENN. That's what you put, okay? And that's the color, the pink, purple, whatever you want to say, that we see on the graph. You just click OK, you click apply, and you can apply that for any stock that you want to compare. AMD, Nvidia is pretty awesome. In the bottom, there's also a tool. I just renamed it to Z-Money. I found it. I don't really remember. Ask me in the comment. I think I googled like Thinkorswim scripts, and this is like the standard deviation. Okay, standard deviation for Thinkorswim. Basically something like that. I really don't remember the name. It's free, you can google it and find out. But basically what it means, guys, that every time the relative value between two competitive stocks it should be traded between this, the red line, and the yellow line, okay, between this and this, and every time it goes either above it or below it, that means that one of the two is either overvalued or the other one is undervalued. So the way I looked at that, first of all, I need to have a biased direction for the industry. And my biased direction is long. I'm long online betting as an industry as a whole. But as of now, I have two options. I have DKNG and I also have Penn, PENN, which is the competitor. So while everyone on TikTok, YouTube, Reddit, Twitter will tell you go buy the DraftKings, okay, they don't tell you why. Sure, the industry is very bullish, I understand that, but is this the best bang for your buck? And this tool will show me exactly the answer. So let me show you what I mean by that. So if I see this, and because they're both in the same industry and they're both doing the same, they should trade at the same level, which they are right now. You see all this is PENN. Exactly now, in the last 2 weeks, they super correlated. And before that, starting the end of January. So basically, this month, they finally got to the same level, even here. All this is correlated. All this is correlated basically in the last 2 months. Okay, let's say from the last 2 months, around December 18, December 20, correlated. You see PENN and DraftKings traded the same. There's no trade in here. You either in or you out. The trade was around here. If you see, this is DraftKings at the top, okay, and Penn was around here. I'm not buying Penn because I'm waiting for Penn to be under the red, under the 2 red, okay, which I only got. Basically, I got a signal in here, January 4th. So we're gonna check January 4th, and we're gonna check this one, June 26th. So let's start with June 26th. You see, at June 26th, the Penn to the DraftKings ratio was so out of whack, okay, and basically it passed 2 standard deviation, and on the red meaning that one of them should be is super cheap compared to the other, which I assume this one just by looking at that. So Penn was super cheap compared to DraftKings in this date, June 26. Okay, you see the standard deviation was 2.4 to the negative. So let's look what happened price wise. If you look at DraftKings, let's start with DraftKings and see what your return would be. If you bought DraftKings around June 26th, it was around $32. So $32, and you're still holding all the way here. You made 100%. If you bought at 32, now it's 64. You're a happy camper. Don't get me wrong. You're a happy camper. You bought DraftKings because everyone told you to do so, and you made 100%. And if you hold options, most likely you made a whole lot more. But, and this is the key, guys, this is the key. If you bought Penn right here on June 26th because it broke the 2 standard deviation to the downside, meaning Penn is super cheap compared to DraftKings. And again, let me explain this again, guys. It should trade at the same, correlated. They're both doing the same. It's just Coke and Pepsi. Same thing. There should not be a gap. There should not be a gap where we are right here. There should not be this giant gap. So let's say if I'm putting Penn and I'm going back to June 26th, this is Penn to Penn. That's the comparison. We are here. This is June. Okay, June 26th, right here, and this is where we buy. June 26th, right here, around those lines at $30. Okay, so DraftKings was 32, and Penn was about 30 as well, 29, 30. Let's round it up to, let's say, 30, even though it was a little less. Same date, same everything. You made 100% with DraftKings. You're very happy, but if you bought Penn instead because the chart comparison told you that Penn is super cheap compared to DraftKings in this exact date, June 26, you bought at $30 and you hold it until now because now the two of them are compatible. Well, let's see how much you made. You go up, all the way. We're already at 60, 70, 80, 90, go down to 88, 100. And now we're at 125, 135, well, let's say 120. So, if you bought Penn at the same date at $30 on June 26, because it was 2 standard deviation to the downside cheap compared to DraftKings, 30 to 120, that's 400% on your money. DraftKings did 100% on your money, not bad at all, and everyone are very happy. But the competitor Penn, no one is talking about them, and they both need to trade at the same level. And I haven't even went over Penn financials and all of that. You would have made 400% from $30 to 120 is a lot better than $30 to 60. And if you play options on a 400% return in about 8 months. That's insane return. You just buy the January leaps from June, something like that. And that's how I have started to play those. I start to do some comparison, correlation. And if I see something out of whack, don't get me wrong, you don't find those trades every day. You find them, that's why you need like 50 products, like Coke, Pepsi, I don't know, Walmart, Costco, all that stuff. And if you see those, you see them maybe twice a year. And once you see those maybe once or twice a year, you take, in my opinion, that's how I have started to trade this. I just buy leaps for the end of the year, and I sell. I haven't sold yet, but I will sell once the correlation get back into exactly where we are now. So if you click DKNG, if you bought in June 26, where we are here, June 26, this DKNG. And this big gap between the two is that it's also still gap. Look at this. There was still insane gap between when DraftKings was 60, but Penn didn't go up. Penn was still here, and instead DraftKings just went down. But I didn't buy Penn. You didn't buy Penn in here because Penn wasn't super cheap. It was just the DraftKings right here around September was super expensive right here at around 55. DraftKings was super expensive. It wasn't that Penn was super cheap. We got another option to get into Penn right here if you missed it at January 4th. Okay, let's see what happened January 4th if we're already here. Just for the example, if you click Penn, January 4th was 82 and it went up to about let's say 130. That's not bad. That's 60% return. So Penn, if you missed the first one, that's crazy. See, where's January 4th? Right here, January 4th, right here. If you bought Penn at around 85 bucks and you made 50%, how much was DraftKings around January 4th? DKNG, DraftKings. Right here, January 4th. We got ourselves price of 45 to a price of 60. That's how much is that? 30%. Okay, so this still went up, but again, Penn made 50%, DraftKings made 30% return in the last month. So sure, you made good money on DraftKings, but the alternative with Penn was a lot better. And I can't believe I've traded all those times without this tool. It's all free. All free, you just have to look. Basically guys, if I bring you any sort of value, if you learned anything new today, subscribe to my channel, hit the bell notification, leave a comment below if you are holding DraftKings and if this was valuable to you, and now you can think about, hey, maybe I can buy Penn or DraftKings or any other stock. If you hold Walmart, for example, I did the same chart and to see when is Walmart cheap compared to Costco, compared to Target, and there's so many stuff. And only if you gain value from this video, subscribe, like, hit the bell, all that good stuff. Thank you guys very much, and I will see you in the next video. Yeah.